Dear friends, welcome to weekly view on markets. Markets continued their uptrend in this week from the lower levels. There was recovery in the last week after the Fed meeting. That move has continued during this week also. Major indices gained 1.5 to 2.5% in this week. The rally was broad based as buying was seen in most of the sectors. Technical charts also look quite strong. They have pulled back from the support level last week. We expect the markets to remain resilient as there is FII and DII buying support at lower levels. Corrections are short-lived because of these reasons. Market bounces back quickly because of the institutional buying supports. Investors should not get worried about the day-to-day volatility. They should hold on to their investments. They will get good returns in the next coming financial year also, because the Indian economy is quite buoyant and corporate earnings have picked up and the earnings are quite strong. So because of all these things, we will see good returns in the coming years also. Now let us look at performance of indices. Nifty has closed at 22,326. It has gained about 315 points, that is 1.43%. Bank Nifty has closed at 47,124 with a gain of 439 points, that is 0.94% gain. Mid cap index has closed at 48,075 with a gain of 1,042 points, that's gain of 2.22%. Small cap index has closed at 15,270 with a gain of 310 points, a gain of over 2%. India VIX is quite steady at around 12.83. Most of the sectors have gained during this week, except information technology and media. These were the only two sectors which have seen profit booking. Information technology sector lost about 3.13%. Last week also information technology sector has lost around 5%. Again, this has lost around another 3% this week. Media sector lost 1.7%. Realty sector gained the most, around 4.8%. Auto sector is quite strong. It has recorded further gain of 3.47% over last week. Infrastructure sector continues to gain more than 3%. Healthcare gained around 3.04%. Metals, manufacturing, FMCG, PSU companies, consumptions, oil and gas sector, pharma sector all gained more than 2% during this week. So this is a smart recovery from the lower levels. Now let us look at technical charts. This is the daily chart of Nifty. Here we can see market has bounced back from the support level. This lower line which I have drawn is the support line. So this line was drawn much earlier. We can see that from the support line the market has bounced back, and if it crosses around 22,400 levels, market technically becomes more strong and we will see market touching newer highs in coming weeks. This is the daily chart of Nifty Mid Cap Index. Here too we can see Mid Cap Index dropped below this lower support line, and again it has smartly pulled back from this. Now it is in the mid range of this channel. And we can see last 2 days, 2 days candles are seen red. That means it, there is a profit booking coming at higher levels in the mid cap space. This shows that mid cap index is likely to consolidate around these levels in the coming week. This is the chart of Nifty small cap index. Small cap index from the highs has corrected a lot and it has taken support at around 14,500 levels. And from here, it has given a good recovery. And now it has crossed the first resistance of around 15,000 levels. And from here on, the small cap index is likely to gain further as per the technical chart. Bank Nifty index continue to consolidate in this wedge formation and the range is becoming smaller and smaller. The range was much wider earlier. It is becoming smaller. And if Bank Nifty takes out 48,000, we'll see a big rally and Bank Nifty will cross 50,000 level for the first time. Now let us look at the fundamental factors of the market. The microeconomic factors of the market continues to remain strong. Core sector growth has come in for February 24. It has come at 6.7%. It was at 7.4% growth in February 23. The base was smaller because of COVID impact in the earlier year. Now the growth rate from 7.4 has come down to 6.7, but the last year base was larger. That is the reason. So, economy is expanding. There is nothing to worry on this. RBI forex reserves is at the highest level of 642.61 billion. INR dollar rupee rate is at 83.40 per dollar. Dollar index has slightly gone up. It is at 104.49. This shows that globally there is a demand for dollars. Brent crude is at $86.20 per barrel. Rise in crude price is a concern for Indian economy. If the crude price keeps going up, that will put pressure on our oil import bills and also it will fuel inflationary pressure in Indian economy. Gold prices is going higher and higher. It is at 68,450, one of the highest levels in the recent times. FIIs continue to buy. They have bought 2,369 crore in equity and DIIs have bought 8,913 crore in equity in this week. So whenever market is falling, FIIs and DIIs continue to buy. That is the reason corrections in the markets are short-lived. They are quickly bought and market again comes back. The financial year is over with this week. So next we are entering into the new financial year. Markets are expected to give good returns in the next financial year also on the back of strong economic fundamentals and good corporate earnings. RBI policy meet is there in the first week of April. The meeting will start on 3rd April. Market will look for that. There may be volatility due to the election related news in the markets. But these corrections will be a good opportunity for buying. Corporate results for the fourth quarter will start coming in the month of April. That is for the fourth quarter. So market will look forward to the results of the companies. There could be some volatility, but investors should not worry about short-term volatility. They should remain invested. Mutual fund investors should continue their SIPs. So I hope the next financial year also will be good and investors will get good returns from the market. This is all for this week. If you like my video, please subscribe to my channel. You may ask questions which I will reply. You can share video with your friends. We'll meet again next week. Thank you.